Okay, so in this video, we will be discussing on how to trade candlestick patterns. But before I do so, I think it would make sense to kind of do a brief recap to what you've learned so far in this candlestick course. Right? Number one, we talk about the introduction to candlestick, how to read it, the open, high, low, close, etc. Number two, I mentioned to you the limitations of candlestick pattern. For example, candlestick patterns doesn't tell you, how the price moved from point A to point B, from the open to the close. So that is one of the limitations. Okay, the third thing we discuss is the various patterns of candlestick, like, harami, hammer, engulfing pattern, etc. Then also I shared with you how not to trade candlestick patterns. Right, you don't want to be trading them in isolation because it doesn't give you an edge in the markets. And also candlestick patterns by in itself is not a trading strategy because it does not go into stuff like your condition of your trading setup, your risk management, your exits, and stuff like that. And now the fifth section is basically sharing with you how to go about trading candlestick patterns. So needless to say, there are numerous ways where traders can trade these patterns, but for me personally, I find that this two approach works best for me. Number one, market structure, and number two, volatility contraction. And in this video, we will be discussing about market structure. So market structure, what is it? So market structure are simply support resistance on your charts, swing highs and lows, right? These are levels on your chart that attract the most attention because traders all over the world can see them, and this is where they base off their trading decisions, like looking to enter the breakout, looking to place their stop loss at this obvious level. So this is what I mean by market structure. And how you can combine candlestick patterns with market structure is that you are basically looking to enter your trades after strong price rejection, because this is where traders do get trapped. Okay, so let me explain. So as you can see over here, this chart is soybean oil futures, but it doesn't matter what market you're trading because this pretty much work across all markets. So this one I have shared with you, the market is somewhat in the range, you can see, right, contained between this area of resistance, support, and support. But the thing that I want you to focus on is this area over here. So as you can see, market is in a range, and there will be traders who will think that since the market is in the range, I want to trade the breakout of the range, right? So over here, as you can see that the strong price decline, such huge bearish candle coming into this area of support, right? And price break and close below it. So there will be traders who look at this, say, oh man, look at this huge bearish momentum, I'm going short. So they go short. Okay, so they short the breakdown. And what happened next is that on the next candle, you got somewhat like a harami, right? This candle is basically inside the prior candle, right? Contained within its range. But I would say that the bulls are somewhat in control as he has managed to close somewhere near the highs. And then this candle over here kind of sealed the deal, where it basically closed much higher with a very strong, or rather long-bodied candle. Okay, so this is a form of price rejection. Why is that? Because price came into this area of support and it got rejected relatively quickly, right? Notice that it comes in and within two candles, poof, it basically rallied higher. It didn't even stay at this level for a long time. It's relatively short. In two candles, it got away from this level. So this is a form of price rejection, the market rejecting lower prices. And earlier, if you recall, I mentioned that traders are trapped. So who are these traders who got trapped? They are basically traders who went to short the breakdown. Right? If you are short over here, chances are you're trapped right now because the market has went against your position. It has rallied against your position. You're feeling the pinch right now. And most traders, I suppose they would use the stop loss. And what happens when the market goes against you? Well, chances are you would endure until you cannot tolerate the pain anymore and you cut your loss. So when you do cut your loss, what happens? Right, from a short position and you exit your trade, it will become a buy order, right? Because you need to use a buy order to exit your short position, and this would fuel further price buying pressure. Right, so this is why this setup works, because you're basically profiting from traders who are trapped when they short the breakdown, right? And this is a form of price rejection. Price comes into a level and move away quickly from that level. Another example is this one over here, is the Euro New Zealand chart. So this is somewhat of a counter trend setup. It's going against this longer term trend, but the principle still pretty much holds the same. Look at this. This is a swing high, a very obvious swing high. traders will look at this chart and will, when it trades beyond this high, they'll look to long the breakout, right? Because after all, hey, the trend is up, right? Price is breaking out of the highs. I better get long, right? I don't want to miss this move. So price, broke out above the previous swing high, and then what happened? The next candle, boom, you got a bearish engulfing pattern. Again, who is trapped right now? Well, traders who are long are clearly trapped, right? Because they expect price to move higher, and now price is turning against them. And once again, eventually when they do cut their losses, it would fuel further price decline. But one thing to mention here is that if you look at the big picture, okay, you have to understand that overall this long-term trend is still intact. So if you were to short this market, don't expect a massive price reversal where the market collapses all the way. No. You don't think along that lines, because more often than not, that's not going to happen, right? Instead, if you are going against the trend and just looking to capture one swing, I would say, over here at this level, right, where, previous resistance could act as support, this is, all you're looking to get out of this trade, just one swing. Or maybe, if you want to have a further targets, this is as far as you'll aim for. Do not expect the entire move to reverse, because, as I've said, candlestick pattern, it does not give you the direction of the trend. Overall, this trend is still towards the upside, and you really want to be quick in taking your profits. Okay, so this is a clear example into why candlestick pattern is not a strategy in and itself. You still have to look at market structure, targets, trade management, and stuff like that. But what I'm trying to highlight to you here is that candlestick pattern can provide as an entry trigger combined with market structure into when to enter your trade. Okay, so with that, just a quick recap to what you've learned in this video. Number one, I said that candlestick patterns combined with market structure like support, resistance, swing high and lows, right, can give you entry points, entry triggers. And you want to enter your trades after strong price rejection, because this is where traders get trapped. Okay, so I hope this gives you a good idea into how you can go about trading candlestick patterns. And if you want to learn more, again, I would suggest going down to my website here, tradingwithrainer.com. Okay, you scroll down and download this ultimate guide to price action trading. We really go in depth into market structure, support, resistance, and stuff like that. So go there, get your copy. It is free. Just click this blue button, enter your email, and I'll send the guide to your email. So with that said, I wish you good luck and good trading, and I'll see you in the next video.